bottom line. And so, if you're in a given industry, if everybody else in the industry is trading at a price-earnings ratio of, say, 10, and the company you're looking at is trading at a price-earnings ratio of 5, then you're going to look and see and look carefully and say, okay, is there anything fundamentally different between these two companies, right? If there is, then there may be a reason why it's trading at that lower multiple. If there's not, then you might want to buy that stock because you know that eventually the price-earnings ratio will start to, or you can expect that it will approach the price-earnings ratio of the rest of the industry. You see what I'm saying? So price-earnings ratio is just a valuation tool. You know, you say what a company should be valued at. You know, the same thing if a company is fundamentally the same as the rest of the companies in a given industry, and their price-earnings ratio is 20, and everybody else is 10. So you probably know that it's overvalued. You know, that it's trading at a multiple that's much higher than the industry. And so you would look for reasons why that happens, fundamental reasons in the company. But if you can't find that, then you can assume that it's overvalued. So some common multiples are, again, sales, the top line, earnings, the bottom line, or EBITDA, which is the most common multiple used in private equity valuation. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So it's going to give you a feel for what the fundamental operations of a business produce, right? So the reason it's before interest and taxes and depreciation and amortization is because, you know, the interest has to do with, the interest that a company pays has to do with what their capital structure is. So if they have a lot of debt, then there's going to be a lot of money paid out. And so the earnings will be lower, but the fundamentals of the business don't have anything to do with how much debt they have. You see what I'm saying? The fundamental of the business depends on how many widgets they sell, how many website hits you get, you know, how you're operating the business. So, you know, the same thing with the tax rate. I mean, theoretically, you know, George Bush could raise the corporate tax rate, George Bush and Congress could raise the tax rate to 100%. So there would never be any earnings, right? But it wouldn't be fair for us to judge every U.S. company, you know, and say, man, there's a lot of shitty managers out there and CEOs because nobody's making money. It's not fair because, in fact, the tax rate is 100%. So again, that doesn't have anything to do with the fundamentals of the business, you know. And similarly with depreciation and amortization, you know, when you have an asset, you know, say a building that a company owns, then they have to account for the fact that the building is losing a little bit of value, you know, over time, or machinery is losing value over time, you know. And so based on that, you know, they have to kind of do little write-offs on the balance sheet and say, okay, this building was worth, or this piece of machinery was worth $200,000. This year it's worth $180,000 if we were going to sell it, right? So that, when you write that down on the balance sheet, like I said, I can't do an accounting lesson, but when you take that value away, it has to kind of go somewhere. You know, like you have to actually reflect that in other parts of the balance sheet. I mean, in other parts of other financial statements. And so what you end up doing is on the income statement, you take that $200,000 and you just sort of subtract it off as depreciation, right? But again, you know, if we're looking at the final earnings, we're going to say, man, they were $200,000 shorter than they should have been. In fact, that had nothing to do with the way they were running the business. It had nothing to do with the fundamental way they were running the business. So you don't punish them for that. It's a non-cash expense, you know. And so I'm really just trying to create, the feeling that EBITDA is a good measure because you keep in, basically you exclude the things that are outside of management's control for the most part, and you add back, something that was taken away that wasn't really losing cash. It was just a write-off. So this gives the best measure of the fundamentals of the business, and also these are all things that can change as soon as new ownership comes in. So you can change the amount of interest you pay. That's going to change. If you do a leverage buyout, an LBO, then you're going to add debt onto the business. So this interest number is going to change. The tax situation may change. Maybe your platform company has a bunch of losses, so you're not going to pay taxes for the next 5 years. And again, depreciation and amortization are non-cash expenses. So from the perspective of a private equity firm, EBITDA is going to be the best measure. And so what you typically see is a certain multiples for certain industries. So the average publicly traded company, on average, of all the 5,000 that are out there, the average EBITDA multiple is 8.5, right? So whatever the EBITDA is, say it's $1 million, that company will be valued in the public markets at $8.5 million. The average private company multiple is about 4. Now that's across industries. That's just a broad, very general thing. So one reason, an incentive for going public, right, is that you trade at a higher multiple. So along with the liquidity and all that stuff, public investors are just more optimistic. So, that's why that kind of exit may be attractive. But just in terms of these first 4 techniques, you can go just based on the book value. You can look at comparable transactions, or you can look at comparable multiples. Again, you're making a case to your boss. Hey, we can sell this company. We can sell this company for $100 million because our EBITDA is $10 million, and every deal that's gone off, in the past, the past 6 months has gone off at a 10 times multiple. So you're making a case based on, sort of reasonable assumptions about multiples. One of the most common methods to get sort of an intrinsic value is discounted cash flow. So the idea here, just the standard definition, uses future free cash flow projections and discounts them using the weighted average cost of capital, derived the present value, which is used to evaluate the potential for investment. Now, again, just to give you a taste here, the point of this kind of cash flow is that you actually want to, what you want to do is you want to get a feel for how much cash a business is going to generate. And then you're going to evaluate it. You're going to evaluate the company based on that, right? So it's not based on what other companies are doing, It's not based on the market value of a company, if it's public or whatever. It's not based on the book value of the assets. It's actually based on the company's ability to generate cash. Almost as if you were taking the cash out every year, which that's one way to get a return on your investment, theoretically, and sometimes it's a way that private equity firms, get a return on their investment. Sometimes they don't sell companies. Sometimes they actually just take cash out of the business, until they get the return that they need. So this kind of cash flow, basically values, the amount of cash that a company is going to generate over a certain period of time. So it could be 5 years, it could be 10 years. But the idea is that then you